Hey everyone, and welcome to The Explainer. Today, we are looking at a massive structural shift that's happening right under our noses in the digital asset space. For years, the narrative around crypto has been almost entirely dominated by pure price speculation. But based on some really fascinating recent data and major industry rollouts, we're seeing the blockchain ecosystem aggressively mature way past that phase. We're literally moving from a world of just trading tokens to a world of profound, real-world utility. I'm super excited about this one.
Okay, let's dive into this. Here is our roadmap for today. We'll start with the digital gold debate, then move into tokenizing Wall Street assets, followed by frictionless Web3 gaming, and finally, wrap it all up with the pivot to utility. So, whether you're a hardcore gamer or a traditional market watcher, stick around because we are definitely going to cover your interests today.
All right, Section 1, the digital gold debate, the shifting narrative of safe havens.
Now, before we can talk about utility, we have to look at the broader macro markets, specifically a sudden breakdown in Bitcoin's recent momentum. What we have right now is a literal tug-of-war for investor capital. This is the central conflict in the markets today. Which asset is acting as the true store of value right now? In one corner, we have Bitcoin trading near $75,600, and in the other, we have gold trading largely flat around $4,500. For the last few months, these two have been fiercely competing for the exact same pool of safe haven money.
So let's trace how this financial evolution played out over a really fascinating 3-month timeline. Back in late February, when the Iran war began and oil prices shot up to over $100 a barrel, investors scrambled for a place to park their cash. And initially, they bet heavy on Bitcoin as that safe haven. By early March, we saw the Bitcoin to gold ratio, which basically measures the per coin dollar price of BTC against the per ounce dollar price of gold, lift significantly from roughly 12 points up to 18 points. Bitcoin was clearly winning. But as we entered late May, that 3-month uptrend decisively snapped. The growth just stalled out over the last 24 hours, penetrating the bullish trend line and signaling that momentum was shifting right back in favor of traditional gold.
And this brilliantly illustrates the sheer scale of that shift. For the week ended May 20th, we saw a dramatic exodus from spot Bitcoin ETFs. They lost over $2 billion. $2 billion! Now compare that to the massive influx of fresh capital into gold and precious metal ETFs, which drew in $2.34 billion. It's a crystal clear market rotation.
Which brings us to our first core takeaway, why this matters. Look, this isn't just some fleeting, random chart pattern. Smart money is rotating, and it's a direct reaction to U.S. economic reality. With the hardening of Treasury yields and the very real prospect of higher-for-longer interest rates in the U.S., institutional capital is making a highly calculated move toward hard assets like gold in the near term.
Section 2. Tokenizing Wall Street assets. BitGet's reality platform bridges TradFi and DeFi.
Okay, so if speculative capital is rotating out of Bitcoin, where is the underlying blockchain technology actually growing? Well, we are pivoting aggressively right now from market speculation to actual, tangible, real-world asset utility. Let's dejargonify this concept of tokenization so we can fully grasp what's happening. BitGet just launched a regulated platform called Reality. The core of this is the R token. An R token is simply a tokenized real-world asset that is backed exactly one-to-one by underlying U.S. securities, held safely by regulated custodians. It is quite literally traditional stocks brought directly onto the blockchain. Fun fact, not too long ago, skeptics thought traditional equities in crypto would remain segregated forever, and now they're literally sharing the exact same wallet.
Now, what's really interesting about this slide is how holding traditional U.S. stocks in a crypto wallet actually works in practice. Notice the huge contrast here. With traditional stocks, your dividends are paid in fiat currency. On the BitGet Reality platform, those dividends are paid directly into your wallet in stablecoins. Traditional stocks restrict you to standard, rigid market hours. The Reality platform, it allows minting and redemption around the clock on weekdays. And honestly, perhaps most importantly, while traditional asset utility is isolated within the TradFi system, these R tokens can be transferred freely on-chain and used as collateral within decentralized finance or DeFi protocols. It's wild.
I do want to highlight an absolutely crucial point here. This is not the Wild West of crypto. BitGet's infrastructure relies on a FINRA-registered SIPC member broker-dealer. They have direct links to the NASDAQ and the New York Stock Exchange. The securities are ultimately registered through the DTCC. This is deeply, deeply integrated with the traditional, highly regulated U.S. financial infrastructure. We're talking by-the-book stuff here. And here is our second Why This Matters anchor. Historically, there has been a massive trade-off in crypto. You could either have strict regulatory compliance, or you could have decentralized usability. You almost never got both. Platforms like this completely eliminate that trade-off. They are reshaping capital markets by reducing the friction tied to settlement times, geography, and trading hours, seamlessly blending familiar financial assets with the absolute flexibility of blockchain networks.
Moving right along, Section 3, Frictionless Web3 Gaming, the Mouse and GX Chain Partnership.
Speaking of reducing friction, let's shift our energy to consumer adoption. We are jumping from the high-stakes world of Wall Street to the massive, incredibly fast-paced world of Web3 gaming. But to really understand the solution here, we have to validate the friction point players are facing right now. Traditional crypto gaming has a massive user experience problem. It's plagued by high network costs, unpredictable gas fees, and severe transaction delays. Think about it. If you're playing a game that requires frequent in-game microtransfers, having to pay a gas fee and wait for network validation every single time you make a move totally ruins the experience. It doesn't feel like conventional gaming at all.
Enter the Mouse and GX Chain Partnership. Mouse brings a super user-first Web3 network to the table, and they're combining it with GX Chain's high-performance public blockchain infrastructure. The result? Exactly what gamers have been begging for. Zero-fee blockchain transfers. High-speed and seamless transactions that actually feel like traditional gaming. And crucially, much lower operational costs for the dApp developers who are actually building these games.
2 million. Take a second to let that number sink in. That is the massive scale of what we were talking about here. This specific integration is built to support over 2 million consumers in the TON gaming community. 2 million active gamers who will instantly benefit from the zero-fee, high-speed infrastructure. That is a real game changer.
Which leads us to our third Why This Matters anchor. This goes way, way beyond just making a video game more fun to play. Frictionless dApp deployment is the holy grail for expanding Web3 adoption to the mainstream. When users can interact with blockchain technology without constantly worrying about gas fees or network delays, and when developers can build without crippling operational costs, the entire ecosystem scales beautifully.
Let's move to and see how this builds into Section 4, the pivot to utility, connecting the dots across the ecosystem. So, the crucial point is this. We are seeing institutional capital finally move past pure asset speculation. We saw that perfectly evidenced by the strategic rotation out of Bitcoin ETFs and into gold based on interest rates. But in the background of all that dramatic price action, the real building is happening. We are integrating heavily regulated real-world assets directly onto the blockchain with tokenized US stocks. And simultaneously, we are delivering truly consumer-ready applications that abstract away all the technical friction, like zero-fee Web3 gaming for millions of users. Which leaves us with this final, somewhat provocative thought to consider. If the true value of blockchain is found in frictionless infrastructure, if traditional stocks are moving seamlessly on-chain and massive gaming networks are operating with zero fees, is the daily price of Bitcoin still the most important metric for evaluating the success of crypto? It's a big question, and it really challenges us to look beyond the charts and recognize the incredible technological utility being built in the background every single day. Thanks so much for joining me on this explainer, and I'll catch you next time.